The host of Wall Street Week, David Westin, joining us as he does every day at this time. And of course, this is actually a pretty big day. We had an IPO today, biggest of the year. But more importantly than just that IPO, there's a big question here about whether this signals a pickup in deal activity.
Yeah, it's a bit of a dry patch, hasn't it, Romaine?
Absolutely.
And the question is it going to change the world for IPOs?
Yeah.
Unfortunately, we have somebody who knows about that. She is Kristin Roth DeClark, Global Head of Tech Investment Banking at Barclays. Kristin, thank you so much for being with us. I know Barclays played a significant role in this IPO. It limits how much specific you can say. But first of all, what do we know so far about that Arm IPO? What does it tell other people in the market about IPOs at this point?
Well, I think one thing I will say for sure is the IPO market right now, this is a really fun time for me personally and for people like me to take companies public, because we have an investor universe that has to kind of look at everything because there has been such a dearth of IPO activity, but they don't have to buy everything. And so it really is a fundamental sale to the investors. And so you end up with these high quality orders coming in. It's not the FOMO world of, chasing momentum that we saw towards the end of, 2020, 2021. It is much more of a fundamental sale. And so what we get to do where we, connect buyers to these businesses, you're selling something that they're buying something for 2 or 3 years out, not just chasing momentum.
So what has changed, if anything, Kristin? I mean, we have higher rates still. Those haven't gone down. There's still some uncertainty in the marketplace. Is it just pent-up demand? But why do you think it might be turning around?
Yeah, I think there are a couple of things that are leading to the investor appetite today. Partially, it is the fact that a number of companies that financed in, let's say, 2020, 2021 at multiples that are significantly higher than what we've seen historically and certainly significantly higher than today, have had the opportunity to really evolve their business models in a way to become, basically have some discipline around cost, get to profitability for a lot of these companies, and be in a position to where they are much more scaled and have cost bases that will allow them to continue to grow and be profitable. And so that's one thing that I think has changed. The other is I do think investors have more confidence in the levels that we're at from a valuation standpoint more broadly in technology, and are starting to see the competing tension in the public market of M&A from strategic, take privates, for example, or from take privates or from strategic activity leading into the end of this year.
Well, that's what I'm interested in, Kristin, here is about, I guess, price discovery. And we know that investors, at least for Arm and a couple others, have sort of found some comfort level with the valuations that they're getting. What about the flip side of that? How comfortable are the companies themselves, these private companies that are looking to go public, with the idea that their valuation is most likely going to be lower than the last private round?
Yeah. And that's going to be the case probably for the next year and a half, because of where companies raised capital in 2020 and 2021 and where those multiples were. There isn't a stigma associated with raising money at a lower valuation than your last private round. And so that's helpful. The other thing is a lot of these IPOs are small relative to the market cap of the company. So you're looking at very little dilution if you're selling any primary stock in the IPO. And it's more about where does this stock trade in the aftermarket? Who are the investors that are buying it, and are they really committed for the next 2-3 years of the company's growth phase, and less about what is the absolute price on the day of IPO.
If we are sort of entering an era where we're going to see more deal activity, whether it's because of Arm or maybe just because of macro conditions and the Fed are now maybe a little bit more favorable, does that necessarily mean everybody can come through the door? Because, I mean, let's be honest. I mean, there was a stretch in 2020, 2021 where there was a lot of garbage coming to market. And now what you've seen coming to market are much more mature companies, companies that have much more of a track record of revenue growth and profitability. Is that going to end up being the landscape?
I think that the bulk of the companies that have been waiting in the backlog for a couple of years now, that have really gotten, as you said, more scaled, they have a longer track record of growth at scale, and they have more discipline around profitability. I think the bulk of those companies are still probably going to go public next year, but they're gearing up now. And I think April is probably going to be a busy month, April-May timeframe, because that's really the inflection point of when companies can get credit pretty comfortably for the 2025 estimates. And so if you've waited this long to go public, getting credit for 2025 is certainly helpful. The conversations I'm having right now with companies and their boards about, do we wait till April, May type timeframe where we have full year financials for 23, we have recent developments for Q1 of 24, or do we hit this window? And the three things that investors, or that companies and boards, the three considerations for going earlier and pushing into this year are: one, you get investor focus. As I said before, investors have to see everything that comes to market right now. They don't have to participate, but they have to look at it. Two, you're building a shareholder base that is incredibly strong from a fundamental standpoint. So this isn't this, pile-on momentum type investor mentality. It's a really strong shareholder base to enter your life as a public company. Yeah. And the third reason is, as strategic M&A is increasing, having a public currency in which to participate in that is a positive. So those are the reasons that people are thinking about moving from next year, April, to pushing forward to something, in 2023.
Kristin, you're head of tech investment at Barclays, and this may be talking your book, but how much of this is tech specific? We've been talking about IPOs more generally. Obviously, Arm is a tech company. There are others that are talked about in terms of IPOs, but we also have things like Birkenstock that at least I don't think of as a tech company. How much of this is specific to tech at this point?
I think, the IPO investors tend to favor growth and profitability, or some combination of that. Historically, it was more growth. Today, it's more growth and profitability. You see a lot more companies come that are tech or tech-enabled. And consumer-facing businesses are probably, in the same way, have similar financial profiles. And so maybe it's a little bit more about financial profile and growth rate, confidence in growth rate, confidence in business, in unit economics that's fueling some of the interest from investors. But tech has, touches a lot of other verticals, and it's been disrupting a lot of other industries. And so I think there will be a pretty heavy calendar on the tech side, probably more so than any other sectors.
And Kristin, I'll put you on the spot here at the end. Do you want to make a prediction with some of the ones that might be up next? I mean, whether they're your clients or not. What do you think might be coming? We hear about Instacart, for example, some others?
So I can't comment on specific names necessarily, but I do think some of the financial profiles that I described, in terms of scaled, consistent revenue growth, in some cases accelerating revenue growth, and confidence around unit economics, and either profitable or very close to that.